Back to today's daily dose of market insights. My apologies because there was a slight technical glitch to the laptop earlier, so I need to restart my system. That takes a bit longer. So I believe that all things are good right now. So very good morning to all. Today will be the Thursday, the 6th of November, 2025. So very quickly, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right. So before we jump straight into the gist of the daily dose for today, let's have a quick recap what has taken shape yesterday in terms of news flow, economic data release, and their impact on the respective intraday movement of the broad-based cross-asset classes that we cover on a daily basis. So let's start with the key economic data slash news flow that has been released, that was released, pardon me, during the US session yesterday. So yesterday we do have two key US data in lieu of the ongoing government shutdown that has entered into its fourth week, that is still showing no signs of a reopening. So market participants yesterday will be very interested in this economic data report of the US that has been compiled by a private organization instead of the US official government statistical agency. So yesterday, two key reports that came out. One is the ADP Challenger report. So this ADP Challenger report will be now used as a proxy of by right this week non-farm payroll data. So there's no signs that the US government is going to release the non-farm payroll data. So yesterday, market participants pay very close attention to this ADP employment change data, or they call it the ADP Challenger jobs data. So ADP data came in stronger than expected. All right, so bear in mind that previously, that this ADP data, there is always a discrepancy between ADP and the non-farm payroll data that's released on the same week because of the way they do the calculation is different. So despite the fact that because non-farm payroll is still the data that market participants rely on, but given the fact that it's not being released this week, so all the emphasis being placed on the ADP employment change data that was released yesterday at 9:15 p.m. Singapore time. So it came in stronger than expected. So market participant was expecting 25K. It came in at 42K jobs added. A big jump from negative 29K previously recorded in the month of September. And also another tier one data is the ISM services PMI that measures the health of the services industry in the US, which is very important as well. We know that services activities contribute close to 3/4 of US GDP growth. So it also continued to expand. For PMI data, anything that's above 50 is showing expansion. And how do I read the rate of expansion? By looking at the trend of the numbers as the months ahead. So it came in at 52.4. Market only expecting a slight improvement to 50.8. So there is a big jump in terms of the rate of growth. So if you look at the services PMI trend, okay, come on, okay, it's a bit hang on. So you look at the 10-year trend, right? It's actually inching outwards. So 52.4 is the highest. It actually broke past the August print of 52, and it's the highest number since February 2025. So it's something like a 6-month high. So there's what I call it a increase or in an improvement in services activities in terms of the rate of growth. All right, so within the subcomponent of the services PMI, we also has this survey-based employment, we call it data. So what ISM service, ISM, the private organization, what they do is that they send up a list of questions to the respondent to ask them various, it's a pool of questions. What do they think in their business plan going forward? All right, in the services industry in the US. And one of the component of the questionnaire asks about their employment situation. Where are they hiring or not? Something along this line. So this is considered as a survey-based data, a bit of leading element, stating that whether the hiring manager in the services sector in the US under aggregate, are they optimistic about their hiring plans put it in a way this way. So based on this ISM services employment data, a subcomponent inside the ISM services PMI, there is signs of improvement. So anything that's below 50 is contraction. So the rate of contraction actually reduced. All right. So previously it was at 47.2. Market only expecting a slight improvement to 47.6. So it came in better than expected. Okay. So the rate of contraction reduced at 48.2. So stating that the earlier pessimism regarding about hiring plans by the respective managers in the services sector in the US is not so pessimistic as a month before, right, in September. So the net overall result over here is that it actually reduces the Fed rate cut bets as being a wager on by the Fed funds futures traders for the December meeting. So how do I see that? But if you look at the CME Fed Watch 2 over here, so on the CME Fed Watch 2, I would actually look at the current month, the current tab over here. So this current tab allow us to see for the upcoming meeting, 10th of December. So right now, after the release of that two key US economic data yesterday, previously it was at around give me a minute, 70+%, right? About 70+%. Then now it actually dropped down to 62.5. All right, 62.5. So the odds has started to trim down for a third cut this year in December. All right, so current rate is at 3.75% to 4%. So right now the rate cut bets has been reduced to 62.5%. So it's still above 50, which means that there is still a higher probability that the Fed may cut in the next meeting, which is on the 10th of December, but the probability has reduced. So let's look at the aggregated tab on how market participants in the Fed funds futures market is pricing ahead after the December meeting. That means, i.e., what are the probability that's being assigned to future Fed funds FOMC meeting in 2026. So still recall that yesterday I do share with you guys that the next potential rate cut after December will come in April 2026. So this time around, the April 2026, the 29th of April 2026 FOMC meeting, the odds has been reduced to below 50 at 49.5%. All right, and market is now pushing down further for the next cut. That means, i.e., if the December cut were to go through, that will be the third cut so far, and the fourth cut of this new interest rate cut cycle will be pushed down forward. Instead of April, they will push down further to 17th of June at 94% chance. Okay, 17th of June. Then thereafter, you have a 75%, 76% chance at 16th of September, and either a 93% chance. Then thereafter, they will stamp pad. So still two interest rate cut in 2026, but the dates has been pushed down. All right, over here. So that actually kind of technically from a fundamental perspective, that should actually see the dollar strengthening. But what's interesting over here is that instead of the dollar strengthening, the dollar actually weakened yesterday from a technical perspective rather than a fundamental perspective. So why do I say that? So if you look at the dollar index over here, okay, so this is the dollar index. So this dollar index over here hit the medium-term resistance zone of 100.05, sorry, 100.10 and 100.5. All right, over here, this one, this zone here. Okay, let me highlight it. Okay, 110 and 100.50. Okay, this zone here, and also this line here, the 200-day moving average. So upon hitting this level here, the dollar strength got dissipated, and the US dollar index closed almost unchanged, negative 0.04%. And in today's Asia session, there is a negative follow through, down slightly by negative 0.12%. And yesterday, it formed a doji candlestick, a daily doji candlestick, represent that the bulls are slightly getting exhausted after consecutive 1, 2, 3, 4, 5 consecutive day of up bullish candlesticks, all right, as being depicted in white, all right, where the closing price is higher than the opening price. Okay, so what it represents over here is that there is a technical adjustment based on short-term traders price movement. So sometimes the way that financial market moves, right, it tends to deviate away from the fundamentals. That means, i.e., potentially the previous steep movement 5-day up on the US dollar index, they have started to price in a possibility of the ISM services PMI data and the ADP data that has a high chance of coming in better than expected. That means they kind of front run it, and when the actual data comes up, that has already been priced into the market. So that actually causes the opposite price reaction from liquidly traded instrument like the US dollar index. So that is the possible explanation why the dollar actually moves against from the data released yesterday, which is much rosier than expected, and causes the chances of a Fed rate cut bets to be reduced, as being shared with you guys on the CME Fed Watch 2 data earlier on. All right, and with that, that also allows the US stock market to rally yesterday. So for those who actually followed my daily dose yesterday, I do share with you guys that the market actually hit some key support level, and indeed it did a bullish reversal at those key support level that we highlighted yesterday on the Dow Jones, which is the US Wall Street 30, the S&P 500, and the Nasdaq 100. So all four major US stock indexes closed in the green yesterday, and the one that is rallying the most is the small cap, which is up by 1.54%, followed by the Nasdaq 100 up 0.7%. Then thereafter, the Dow Jones up 0.48%, and the SPX up 0.37%. And if you look at the market breadth yesterday, was rather healthy, because the rally actually what you call it, not only centered on the mega cap technology stocks, all right, over here. So this is the heat map of the S&P 500, all right. So if you look at the mega cap technology stock, yes, they are contributing as well to yesterday's rally. But if we were to go to the groups over here, we are able to see that more than 7 sectors are actually contributing to the rally in the S&P 500 or the US stock market yesterday. So based on the S&P 500 11 sector performance, so what we could see is that all of them are in the green. So we have the top performer will be the basic materials, the consumer services, and the consumer cyclical over here, all right, and also followed by the industrials and financials. So we do not see it skewing towards only the consumers communication services and the technology. So in fact, technology yesterday underperformed, only positive 0.18%, because of that slight in NVIDIA, all right, because NVIDIA is now the biggest weightage in the technology sector, which is down by negative 1.75%. And the reason why NVIDIA is down negative 1.75%, because of this news flow coming out from China, saying that China bans US chips from state-funded data centers. All right, so that causes the NVIDIA NVIDIA share price to tumble yesterday. All right, so and also what's interestingly, since we're talking about NVIDIA, so there was actually a event yesterday where NVIDIA CEO was being invited, all right, over here. So there's this event. Okay, let me expand it. Okay, so it's basically it's on the sidelines of a Financial Times Future of AI Summit event, and he did make this remark saying that China is going to win the AI race. So by saying this remark over here, is very interesting. It created a positive feedback loop into the China big tech stocks. So how do we know that? If we to look at the Hang Seng Tech Index over here, the Hang Seng Tech. So this Hang Seng Tech Index is actually comprises the China listed listed share of the China big tech stocks like Alibaba, Baidu, and the couple of them on Hong Kong. And how do we see their performance? By looking at this Hang Seng Tech. So you see the Hang Seng Tech Index is running so strong today, up by 1.9%. Is due to that remark made by Jensen, the NVIDIA CEO yesterday. All right, so that created a positive feedback loop. On top of that, yesterday I shared with you guys that the Hang Seng Index which is a broader, is the broader benchmark over here, hitting key support level as well. All right, so that actually fuel the rally in today's Asia session. All right, so a rather rosy situation right now as being impacted on the major Asia Pacific benchmark stock indices. So also the Nikkei 225 also managed to bounce as well, up 1% so far as we are speaking. And if you look at the CSI 300, it's also up 1.25%. And the rest of the other Asia benchmark indices also join the positive bullish reversal that has a contributed to a positive feedback loop into the Asia session today among the Asia Pacific stock indices. Kospi up 1.6%. The Thai X up 1% and Singapore STI up 1.13% thanks to DBS, which just reported its report this early this morning that managed to beat expectation, and the share price of DBS shoot up to 2%. All right, so net overall, there is still no signs of a start of a medium-term downtrend phase / major downtrend phase among the global stock indices, which also includes in the US stock indices. All right, so then talking about gold traded sideways. So later I'll share with you the share price of gold, and West Texas crude oil continues to remain lackluster below the $61 per barrel. So later we'll touch more about that. All right, so with that, now let us now focus our attention to the intraday technical outlook on all the broad-based cross asset classes. All right, so before we do that, let me expand my screen over here. So let us start with the FX market. All right, so let's start with the euro dollar. So the euro dollar, very interestingly, yesterday we do have a bearish bias looking for that residual push down towards 114.50. So price action during the start of the US session hit a low of 114.68, 1.1468 over here. All right, haven't really hit 1.1450, but the elements has now started to change. More positive over here. So how do I say that? Firstly, we do have a bullish divergence. Okay, price action do a lower low over here, and the RSI did a bullish divergence. And what the RSI did over here is that it actually staged a bullish breakout from a descending trend line. All right, indicating that the momentum has started to flip from negative, from bearish to bullish. All right, so with this positive element that is being seen on the euro dollar, and also the euro dollar is the biggest component major currency inside the US dollar index. So bear in mind that yes, that if you look at the US dollar index, is shaping this bearish doji candlestick as well, right at the key medium-term pivotal key medium-term resistance zone, right below the key 200-day moving average. So with that, I have no conviction now to actually have a bearish bias to see a push down towards 114.50. So perhaps the residual push down has already been concluded at yesterday low of 114.68 right over here. So this is the low that's being seen yesterday. Okay, 114.68. All right, 114.68. All right, so with that 114.68 will be my intermediate support level to watch. Short-term pivotal support level, I will use 114.50, which I derived yesterday. I don't want to put it so tight at 114.68 unless we have a bullish breakout above the first resistance at 115.30. So with that, today I will flip to a bullish bias for a potential intraday bullish reversal / bullish recovery on the euro dollar. Two resistance level to watch, in fact 3 resistance level to watch. The first one will be 115.30, so this is kind of like an upside trigger level. So if this level is being surpassed, I will tighten my pivotal support level to 114.68. The next 2 resistance level will be at 115.55, followed by 115.80 next. However, only a bearish breakdown below 114.50 on the euro dollar will start to see a continuation of this ongoing corrective decline sequence to expose the next support level at 114 figure. All right, 114 figure level over here. Now, next up will be the sterling pound over here. So the sterling pound didn't shape a bullish divergence over here. So for the sterling pound, I will continue to watch pretty closely because it seems to us that it's still trading within a descending channel taken from the recent high of 18th of September. So at that point in time, that was the September FOMC meeting. So ever since then, the market pop up, then it starts to drift downwards. All right, so I'll be using this pivotal resistance level over here, and bear in mind that there's also a Bank of England meeting afterwards. Later I'll share with you the timing of the Bank of England meeting. So potentially we know that in the last few months, the statistics for the UK economy is not so rosy, so there could be a risk that the Bank of England may ignite one more interest rate cut or a guidance to allow them to do an interest rate cut in the next 3 months. All right, so I'll be still using the short-term pivotal resistance at 131 figure level. All right, so as long as this level didn't surpass on the upside, there could be a residual push down to test the next intermediate support level. So this could be an inflection zone here for a potential recovery at 12970, which is so the lower limit of this descending channel that I drew from the high of September this year. Only a bullish breakout above 131 figure level will invalidate today's bearish bias view to see a recovery towards 131.80 followed by 132.50, which is so confluence with the 200-day moving average and very closely coming close to the 20-day moving average at 133 figure. Right, so that's for the sterling dollar. Okay, next up will be the Aussie dollar over here. So Aussie dollar yesterday we were neutral over here. So it broke above the neutrality range, upper neutrality limit at 65.05 area or the 65 figure level. So with that, the Aussie dollar also managed to shape a bullish breakout above this parallel descending trend line resistance, and also going above the 50 level mark over here, indicating that the momentum now has started to turn positive in the short term for the Aussie dollar. So with that, I will have a short-term pivotal support level at yesterday's minor swing low area, 64.67. So 64.67 will be my short-term pivotal support level on the Aussie dollar. I will flip from a neutrality stand to a bullish reversal, bullish recovery stance in the short term for today. Two key resistance level to watch: 65.30, a breakout above this level, potentially revisit the rejection area of last Friday and this Monday at 65.60. So 65.30, 65.60, which 65.60 confluence with the 50-day moving average. Only a bearish breakdown below 64.67 will see a residual push down to test 64.45 and even 64.30, which is the 200-day moving average, and as well as the ongoing medium-term expanding wedge lower limit, which is the range support level at 64.30 now, that has been in play since 23rd of April 2025 low. So that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen continues to test that important medium-term pivotal resistance level at 154.50 over here. So there was actually an initial squeeze up. So after that squeeze up, it can't break above 154.50. So there's this particular news flow coming out from Japan, saying that this new top currency official in Japan. So Japan over here is that the official in the Ministry of Finance that is in charge of debating or dictating or instructing, put away that instructing Bank of Japan to intervene in the FX market is the MOF vice minister, not the main minister. All right, so they call it the vice finance minister for international affairs, Mimura. So Mimura noted that there has been a steady decline in long yen positions since around summer, owing to factors ranging from trade geopolitics to speculation over Japan fiscal spending plans, which is very relevant right now, given that the new Japanese administration, led by the new prime minister, who is a mentee of the previous late Japanese Prime Minister Abe, who endorses physical expansionary fiscal policy together with a commodity monetary policy. That means very, very low interest rates. All right. So Mimura emphasized that the authorities don't have a specific number in mind which represent an excessive move, but they see the fluctuation in volatility, that means in the FX rate, isn't necessarily explained by fundamental related reason, and they will say it's a bit disorderly or excessive. That means saying that basically we will always say that we should look at the interest rate differential, which I shared with you guys yesterday, between the US and the US dollar, or the US Treasury bond and the JGB. And the currency pair should move in line with the gap. And if you look at the actual movement of the foreign exchange and the movement of the differential between US and Japanese interest rate on public bonds, you do see some sort of deviation recently. So he is actually watching that the movement of the dollar yen rate is not actually in line with the fundamental differential. All right, so basically very quickly, what do he mean by this? So I shared with you guys yesterday as well. This is basically the differential between the JGB yield and the US Treasury yield over here. So this is what he means. Let me push it out, stretch it out here. Okay, so very quickly, yeah, so this is what it means. So the yield differential between US and Japanese public bonds has showing steady decline, but the dollar yen rate is not showing a steady decline. Instead, it's trying to inch up higher since late September this year. All right, so because of that, his remark yesterday, so that causes a bit of hesitation by the bulls to actually scale back their attack at the 15450 level. All right, so if you were to look at now on the hourly chart over here, right, so yesterday initially there was a push up pump. So yesterday we have a tighten pivotal support level at the 15380 level over here. Okay, so this was this level. Yeah, 15380 around there. So it hit the 15450, can't break out and did a U-turn down again. So still no change, right? Yesterday was a nasty push up, but given that this is a very key resistance level, I cannot be bullish, stating that it will break up above 15450. So potentially it may just drift down lower again. So 15450 will be my key pivotal resistance to watch on the dollar yen for a potential bearish move to drift down and retest yesterday's low at the Asia session, which is 15307. Okay, let me put it in exactly 153.07. Okay, 15307. So only a breakdown below 15307 may see further intraday weakness to test the next near-term support level at 15235, which is the 20-day moving average as well. Only a sudden push up above 154.50, then potentially the bulls will be able to gain more traction on the dollar yen to see a squeeze up towards 15540/15550 in the first step. So that's for the dollar yen. So very quickly now, let us now move on to the next asset classes, which is the major stock indices. So let us start with the Hong Kong 33 first, representing the Hang Seng Index. So the Hong Kong 33 managed to do a squeeze up. So like I explained earlier on, why this squeeze up is because of the positive feedback loop in the China big tech stocks, after reinforced by the NVIDIA comments, CEO comments early on, which I shared in my first segment of the daily dose. So given this squeeze up, and now it's breaking above our resistance level at 26,310. So with that, I will tighten my pivotal support level for today's Asia session low. We saw confluence with the 20-day moving average and the 50-day moving average as well at 26,045. So we adjust according to the latest price action. All right. Over here, let me do the adjustment for you guys. Okay, 26,045. Oops, sorry, 045. Okay, so this will be the next normal support level. Okay, let me delete this. Okay, push it up. Okay, so 26,045. 045 will be my short-term pivotal resistor, a tighter one, given the price action has broken above 26,310 right now as we're speaking. So next resistance level to watch will be 26,695. Then after this level will be the previous gap down over here. Okay, there's this gap resistance. The near term at 26,965. Okay, 26,965. Okay, then for reference, the major resistance will be at 26,500 that got almost very closely rejected on the 2nd of October, where it kickstart this messy corrective wave movement. So why 26,000, why 27,500 is very important. So bear in mind that 27,500 is actually a major upside trigger level. So if we go to the weekly chart of the Hong Kong 33, represent the Hang Seng Index. So this 27,500 is in fact the long-term circular descending trend line, linking its current all-time high that was only printed in January 2018. So that was the all-time high then. So if we're able to break out this 27,500, which is the long-term circular descending trend line from that current all-time high that was in January 2018, it actually potentially kickstart a new major uptrend phase for the Hong Kong stock market. So indirectly, the China stock market has now starts to see a new major uptrend phase as well. So that's why the 27,500 is very, very important from a technical standpoint. All right, over here. So these are the short-term levels for you guys to take note of. Only a bearish breakdown below 26,045 will reinstate that minor corrective decline choppy movement sequence again, revisiting 25,760 on the Hong Kong 33. If this level can't take hold, we'll potentially revisit yesterday's bullish reversal low at 25,500 next. All right, so that's for Hong Kong 33. Next up will be the Japan 225, representing the Nikkei 225. So the Japan 225 continues to burst up as expected over here. So it hasn't hit our second resistance level yet. It hasn't surpassed 51,730. So given that it hasn't surpassed above 51,730, I don't want to tighten my short-term pivotal support to be so tight at 50,090. Still remaining at 49,370 unless we have an hourly close above 51,730, that I will tighten it up towards 50,090. All right, so above 51,730 will potentially take us up higher towards 52,775 slash 52,830, followed by 53,290 slash 53,590, which is coming towards the top of this medium-term ascending channel that has been in place since the low of 7th of April. Only a bearish breakdown below 49,370 will expose a further weakness to test the medium-term pivotal support level at 48,450. All right, so that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 represents German techs managed to clear above the upper boundary of our neutrality zone. So still recall that yesterday we were neutral between 23,990 and 23,600. So given that it managed to pierce up above the upper neutrality limit, so potentially it will go up to the top of this sideways range, messy sideways range configuration again. We in this very multi-month medium-term ascending triangle configuration. So we're going to the daily chart. So this is what I mean by the ascending triangle range configuration that we're talking about. That has been in play since the high of 19th of June, right? Close to about 6 months. All right. So on a daily basis, some levels for you guys to watch. Intermediate support level will be yesterday's upper neutrality range resistance, now turns into an intermediate pullback support at 23,990, which is confluence with the 50-day moving average. So I'll use a slightly lower level, which is the overlap level, the former minor swing high over here. So if this is indeed a 1, 2, 3 and a wave 4, the wave 4 shouldn't surpass below the overlap, which is at 23,855 level. So using 23,855 as my short-term pivotal support level, flip to a short-term bullish bias stance. We in this sideways range configuration. Two intermediate resistance level to watch for today will be at 24,180, followed by 24,270, maximum 24,380, which has been a minor range resistance since the high of 15th of October. Only a bearish breakdown below 23,855 will invalidate today's bullish bias stance to see a slide down to retest yesterday's bullish reversal low at 23,600. So that's for the Germany 30. Next up, US major stock indices. starting with the US Wall Street 30 representing the Dow Jones Industrial Average. So the Dow Jones Industrial Average already, as expected, hit the resistance level 47,460, but didn't surpass above it and drift down over here. So with that, my short-term pivotal support level remains will be at 47,040. All right, which is yesterday's European session low. Unless we have a bullish breakout above 47,460 thereafter, then I will tighten my short-term pivotal support level to 47,255. So for now, 47,040. Next resistance level to watch, 47,750. Above it, potentially see a higher high or a fresh all-time high at 48,190/48,240, which is defined by a Fibo extension cluster level. Only a bearish breakdown below 47,040 will revisit the medium-term pivotal support level at 46,740. All right, so that's for the Dow Jones Industrial Average. Next up will be the SPX 500. So the SPX 500 hit our first resistance zone, 68.30, 68.50. So with that, I will slightly tighten my short-term pivotal support level for today towards 6775, which is coming very close to the 20-day moving average. Maintain that bullish bias on the US SPX 500 above 68.50, potentially seek a higher high at 68.80. Above 68.80, potentially seek out a new fresh all-time high at 69.40, which is defined by a Fibo extension cluster level. Only a bearish breakdown below 67.75 will negate today's bullish bias to revisit the medium-term pivotal support at 67.20. So that's for the SPX. Next up, Nasdaq 100. So Nasdaq 100 also hit our resistance level, 25,800, almost close. Printed a fresh printed intraday highs at 25,780. So I will tighten my pivotal support level to this overlap over here, which was yesterday minor swing high area, the congestion area during the European session, where at the start of the US session it bursts up. All right, so now turns into a critical pullback support. So short-term pivotal support level 25,430, maintain that bullish bias. Above 25,800, potentially takes us up to 26,160, followed by 26,250, 26,340 next. Only a bearish breakdown below 24,430 will negate this bullish bias view to seek out a retest at the medium-term pivotal support level, which is also yesterday bullish reversal low level at 25,200. Right, so that's for the Nasdaq 100. All right, now heading towards the commodities market, looking at gold XAU/USD. So gold continues to churn in a sideways range over here. So what I could see is that the candlestick also getting quite lackluster with a very small little candlestick representing the lack of bullish momentum as well. So no change. We'll still be using the pivotal range resistance level, short-term pivotal range resistance level for 4,036, 4,062 short-term pivotal resistance zone. Maintain that bearish bias for it to drift down towards the lower limit of this minor sideways range configuration at 38.95, 38.64. All right, 3,895, 3,864. Only a bullish squeeze up above 4,062 will negate this bearish bias view to see a further corrective rebound towards 4,155 next. All right, so this 4,155 is very important. So in order for the boost to have a much more, to kickstart a fresh impulsive up move to seek out a fresh all-time high, you got to have a clearance above 4,155, because at this level is previously where we see a bullish hammer candlestick right at the 20-day moving average. It tried to bounce 3 times, but can't surpass above the 4,155 level. All right, so that's for gold XAU/USD. Lastly will be the West Texas crude oil over here. So the West Texas crude oil continues to drift down over here below 60.10. All right, over here. So with this breakdown of this 60.10 level, okay, this level got broken down. Okay, so I will actually tighten my pivotal resistance for today at 61.10. All right, so using a slightly tightened pivotal resistance for better risk management. $61.10. Level. So this will be the next resistance level to watch. Okay, just to tidy everything. All right, so using 61.10 as my short-term pivotal resistance level, we will flip to a bearish bias on the West Texas oil, Next near-term support level to watch will be 59.15. Only a breakdown below 59.15, 59.15 will expose further weakness towards 57.90 on the West Texas crude oil. However, a bullish breakout above 61.10 will potentially see a squeeze up to revisit this Monday swing high area at 61.70, which is so correspond very closely to the 50-day moving average. Only a bullish breakout and hourly close above 61.70 will see a substantial rebound, minor corrective rebound to retest the all-important resistance level at 63 level, which is the rejection level on 24th of October and as well as 9th of October at 63 figure level. All right, so that sum up the all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for other than the Bank of England meeting today? So if we go to Thursday, all the way down. So the Bank of England meeting over here will be at 8 p.m. Singapore time. So before that, we have retail sales for Eurozone at 6 p.m. So that will potentially influence the euro dollar, the euro crosses, and the Germany 30 CFD index. So the more important one in the FX market will be the Bank of England interest rate decision. So market participants is expecting no change at 4%, but we will look at the minutes that will be released at the same timing as well at 8 p.m. Singapore time. So market will be scrutinizing, would there be any mention of any further deterioration in UK economic growth? So if that is being mentioned, that could potentially open up scope for another potential interest rate cut by Bank of England in the next 3 months over here. All right, so something to look out for. Then thereafter, all this initial weekly jobless claim by the US statistical board, so that shouldn't be released given that the ongoing continuation shutdown of the US government over here. All right, then we have 2 Federal Reserve officials speaking at 12 a.m. Singapore time on early Friday. Fed Bar and Fed Williams will be speaking, and 1 a.m. Fed Hammock over here. And at 4:30 a.m. we have Fed Wheeler over here. So Fed Wheeler is one of the more dovish official among the FOMC members. So market participants will be hearing his tonality, especially we have a mixed slew of Federal Reserve officials speaking spoke in the last 2 weeks, stating that there are some of them are still concerned about elevated inflation. So market participants will be hearing what's the viewpoint of Fed Wheeler would be like given the ongoing government shutdown and also after the ISM services PMI data that came in better than expected. Right, because he was actually a dovish, more dovish officials among the FOMC members. All right, so that sum up today's daily dose of market insights. So for your information, I will be not around on Friday. Okay, coming Friday will be on the 7th of November. I'll be off overseas for a business trip, and I'll only be back on 17th of November. So there'll be no daily dose on the 7th of November, and as well for the week of 10th of November to 14th of November, and daily dose will only resume on 17th of November. So with that, I wish you all a great week ahead, a great weekend. To take note of the volatility of the market right now. So risk management is still pivotal, especially in such volatile situation. So with that, I shall speak with you guys again soon on the 17th of November. This is Kelvin here, signing off.